My name is RJ Kelly. I am an MDRT member from San Diego, California. And the title of my talk is, Why Didn't My Tax Attorney or CPA Tell Me About This? And the subtitle, Finding Premiums and Assets to Manage by Saving Clients Large Amount of Taxes. Now, I may only be a simple country boy from Yakima, Washington, but I learned fairly early in my career that if I could save a client income taxes and capital gains taxes, and also, if I could eliminate any federal and state death taxes or inheritance taxes, three really nice things is going to happen. First of all, my client would have more money to invest with me. Secondly, my client would have more money to buy life insurance, disability insurance, and long-term care insurance. And number three, my client would be usually very willing to open their Rolodex. And for all the millennials in the audience, you have no idea what I'm talking about, but to introduce me to friends and family that would likewise be interested in saving taxes too. So the point of my talk would be to address some of the biggest ways to reduce taxes, first at the entity level, and then secondly, go then to the individual level or the shareholder level. So one of the biggest areas of tax deduction is what are called so-called captive insurance companies, which is IRS Code Section 831B, which allows deductions of up to $2.3 million per year to the parent company. Now, there's controversy about this. IRS has been going after 831B elected captive companies, but mainly because whoever set up the company did so in an egregious way. And there's a way to do it. And virtually all of the Fortune 500, as well as the majority of the Fortune 1500 companies, all have their own captives. So as long as you do it right and don't try to push it, you'll be fine. It's a way to be able to diversify your holdings. It's also a way to provide asset protection because now you've got a second company. It reduces taxes, obviously, to the parent company, which is the primary reason for it, and can be used to create velvet handcuffs on key employees if you include them in some of the ownership. But one of the biggest things it does is it enables it to pass assets multi-generationally without any gift or estate tax, and literally millions and millions of dollars potentially. So not without controversy, but it's right down the middle of the code section, particularly for small companies that have exhausted all their deductions. Again, a $2.3 million deduction per year is a pretty nice deduction that most people aren't coming in and talking about. Second idea is to superimpose what we call a cash balance pension plan on top of a 401k or profit sharing plan. It oftentimes creates very significant deductions, $300,000, $400,000 a year or more. I know I set one up for myself. And also typically 75 to 90% of the contribution just goes to the owner of the company. And even with companies that I've got clients with 30 and 40 employees, and they still got almost 90% of the contribution. Now, time and the committee's interest permitting, I can discuss the use of income shifting to deduct contributions from, say, if it's an S corporation or an LLC, to a standalone C corporation. It's usually a marketing company. And as long as the client's ownership is de minimis, less than a certain percentage, and then the balance of the ownership is majority owned by two friendly shareholders, the client can deduct a number of different tax advantaged benefits type programs that are also non-taxable to the client. Now, at the individual level, there are numerous tax deduction or tax elimination vehicles to either defer the recognition of the gain for up to 30 years. Let's say the sale of, again, an S corporation. There's only really one way to do that because S corporations don't play in the tax sandbox well with any other strategy, but they will with this 30-year tax deferred installment sale. Sale of appreciated stocks, bonds, mutual funds, ETFs, real estate, so forth. Now, first of all, there's a philanthropic trust that was created in the 1969 Tax Reform Act, but it got a fresh coat of paint in 2017, and it's much better than a charitable remainder trust. But it does the same things. It eliminates the taxes on the sale of appreciated assets. It gives an income stream to the grantors, but for up to 4 generations, whereas the best you can do with a CRT is 2 generations if you're lucky. You can buy real estate using debt. Cannot do that in a charitable remainder trust. Kills the CRT. And this you can get a bank to loan you money and you're off to the races. It's creditor protected. There's a number of other benefits as well, and nobody's talking about it. Nobody knows about it. So again, it's a big advantage there. Well, one of my favorite techniques, and not without controversy, I might add, is what I call the 30-year tax-deferred installment sale. Different code section. We use it quite often in our real estate transactions as opposed to a 1031 exchange. As I mentioned earlier, it's the only strategy that works for an S corporation sale to defer the recognition of gains. And it has a 6.5% deal cost. So the client gets 93.5% of the net sales proceeds within 24 to 48 hours of sale of escrow closing. Boom, big check shows up in whatever checking account they told them to send the money to. Now I got typically millions of dollars to invest for the client. There's no charitable deduction because it's not a charitable technique, but they can use some of the earnings to go to their favorite charities, of course. Doesn't eliminate the tax, but does defer it for 30 years and gives you the cash in your pocket. We've done run at 50, 60, 70, 80% tax rates. Still better to take the money now, pay the tax in the future. And you could mix and match. You could use this technique for part of it, part of the sale, use the philanthropic trust for a different part. If you want to pay taxes, fine, you can do that for another part. Last idea I could get into, I mean, there's plenty more, but something I call a Terminator Trust, which is where you place assets in a trust for a period of years, could be 5 years, 10 years, 15 years, whatever the client wants to choose. Income goes annually to a charity for that period of time. And then at the end of that period of time, the assets return to the client. Hence, Terminator Trust, because I'll be back. So it's for clients that are moderately wealthy or successful, but they're not so wealthy that they can't, they can afford to give away a large amount of assets. So this way they get the assets back. Tax deduction in year one is anywhere from usually 50 to 55 to 60 cents on the dollar. So if they have a big liquidity event, they need some tax deductions, boom, that's a great way of doing it. And the assets can be managed by a financial advisor. So hope that's helpful. I'd love to have an opportunity to share about some of the things we're doing in the tax mitigation side of things and what that's done to help our practice. Bye for now.